Welcome. Today is August 26th. I'm Jeff Huge, Chief Investment Officer at JWH Investment Partners and editor of Alpha Insights. And this is your Daily Five. Today, I'd like to start out a little bit differently. And first and foremost, I want to inform everyone watching today a little bit of a shameless commercial. But we launched a new newsletter. It's a big picture newsletter entitled Huge Insights, and we're offering it for free for the first 3 issues. And we launched it actually a couple months ago with the first issue. So we just published the second issue yesterday. And if you're interested in taking a look at it, we've gotten a lot of good feedback so far. You can access it for free on our Twitter feed, which is at @alpha_insights. And if you go there right on our Twitter profile, you can sign up for the newsletter and access it directly. Okay, slide number 1, we've got a quote from Scott McNealy, and those who have been in the business for a while or remember back in the late 90s, Scott McNealy was the chairman and CEO of Sun Microsystems. And famously at a tech conference in March of 2000, about 2 weeks before the market topped, he had these words to say to investors. He said, quote, "At 10 times revenues to give you a 10-year payback, I have to pay you 100% of revenues for 10 straight years in dividends. And that assumes that I can get my shareholders on board. That assumes that I have zero cost of goods sold, which is very hard for any computer company. That assumes zero expenses, which is really hard with 39,000 employees. That assumes I pay no taxes, which is very hard. That assumes you pay no taxes on your dividends, which is kind of illegal. And that assumes with zero R&D for the next 10 years, I can maintain the current revenue run rate. Now, having done that, would any of you like to buy my stock at $64? Do you realize how ridiculous those basic assumptions are? Do you need any transparency? Do you need any footnotes? What are you thinking?" So McNealy's basically pointing out what we're dealing with today. The top 7 stocks in the S&P 500 have a weighted average price to sales ratio of 10.5 times. Now, if we take those stocks, Apple, Microsoft, Google, Amazon, Facebook, Tesla, and NVIDIA, and look at what they aggregate as a percentage of the S&P 500, it's 25.5%. Those 7 stocks represent a quarter of the market cap of the S&P 500, and they're trading at a ridiculous price to sales ratio, which Scott McNealy back in March of 2000 basically assumed that investors are crazy to buy his stock. So let's take a deeper look at valuations in slide number 2. So, valuation doesn't matter until it does, right? And I think the point that we've been trying to make for some time now is that it's the sequential improvement in fundamentals from one quarter to the next quarter that allows investors to maintain their confidence in the market. And it makes it possible for investors, especially institutional investors, to extrapolate the trend of the fundamentals higher. And that's what compels them to pay a higher multiple. Once the sequential improvement in growth ceases, then the multiple compression begins. And what we're looking at right now in terms of valuation, using the most objective prism we know, which is total market cap to GDP, we just logged a new extreme at 202% this month. Now that compares to a prior cycle high of about 148%, which was recorded in March of 2000. Another interesting compare in terms of valuations is the Shiller CAPE ratio, the cyclically adjusted price to earnings ratio. That's now reached nearly 39 times versus its March 2000 record high of around 44 times. It's more than double the historical average of 17 times. And so, we've really got a fairly lofty valuation in terms of earnings and in terms of market cap to GDP. But when we take a look at the S&P 500 specifically, dividend yield is now down to 1.3%, which is again challenging its 2000 lows. And price to sales has set a new all-time record high of 3.1 times for the entire market, exceeding the previous extreme in March of 2000, which was 2 times, by more than 50%. So, the point we're making here is that valuations have really reached a historical extreme. And it doesn't mean that they can't go higher. It just simply means that, we're in that 10th decile of valuation, and performance going forward is generally not very favorable. So let's take a look at chart number 3. Chart number 3 really looks at the leverage embedded in the market. Now, most investors assume incorrectly that when margin debt makes a new high, it's a bearish signal. In fact, it's increasing margin debt that actually pushes stocks higher. It's, margin debt to equities is akin to Fed money printing. It's the same sort of impact on the market. And so, it's really the point where margin debt ceases to continue to expand and actually reverses that is the bearish signal. And that indicates a reversal in investor attitudes from, a peak in bullish sentiment to a deterioration of that sentiment. And what we're looking at in margin debt today is the first month-over-month decline since March of 2020. So June margin debt set an all-time record at $882.1 billion. Yesterday, July margin debt data was reported by FINRA at $844.3 billion. That's about a $38 billion decline. So that month-over-month decline is a signal to us. Now, the year-over-year growth rate for margin debt actually peaked back in March at 71%, and that reversed lower now by some 34 percentage points to just 37%. We would also point that margin debt has slipped to just 1.85% of total market cap. So, the point that we're really making here is that margin debt typically makes its cyclical peak ahead of the market. And so we're kind of in that zone where the market should be poised to peak, if not now, in the very near future. So let's take a look at chart number 4. Chart number 4 really looks at the market's breadth. Now, the NASDAQ composite, the NASDAQ 100 have been really leading the charge this summer, and actually this week as well. I think for the week, we're up over 2% on the NASDAQ versus the S&P closer to around 1%, 1.5%. But the important thing here is that, the NASDAQ made its all-time closing high on Wednesday. And, what we saw in terms of participation was a completely different story. The percentage of stocks above their long-term trend line, or 200-day moving average, as technicians would view it, has deteriorated down to a low of 37%. So less than half the stocks are participating in this rally. And in fact, market breadth is measured by this participation above the 200-day moving average actually peaked back in February. And so we've been seeing this deterioration for some time now, the past 6 months, and we just logged a new 15-month low on Friday last week. So this glaring negative divergence between price and breadth really speaks to how reliant the major averages are on those mega cap tech and internet stocks that we talked about on slide 1. So let's move to slide number 5 and talk some technicals here. Slide number 5 takes a different sort of approach at looking at the market. Now, this is a very short-term chart on the left. It's the S&P 500 on a 4-hour basis. So each bar is 4 hours of market timing. And what we've noted here, and this plays to our longer term analysis of the market using Elliott Wave principle, is that we're approaching what appears to be a terminal pattern in the market. And so using Elliott Wave principle, there's a specific pattern, one of 13 patterns that Ralph Nelson Elliott identified. And this is known as an ending diagonal triangle. It only occurs in the very final stage of the market's advance and usually indicates a market reversal, or a top and then a reversal. And the reason that we know that this is an ending diagonal is because, to the right, you can see this idealized ending diagonal pattern. And there's some really specific characteristics. Number one, you need to have converging trend lines. So if we put a trend line on point 1 and point 3 and point 2 and point 4, they should be wider at the base and narrower at the peak. And that's exactly what's happening. They're converging. The other thing that's important is that wave 4 is allowed to overlap wave 1 in this particular case. And that's exactly what we're seeing. Wave 4 actually pierced into wave 1's territory. And the other thing is that wave 1 should always be the longest wave. Wave 3 should be the second longest wave, and wave 5 should be the shortest wave. Now, we're at the proposed target that this pattern would suggest, about 4,500 on the S&P. But there is the allowance for what's known as a throwover, up to about 1%, which would be basically another 45 points to the upside. So the S&P has the potential to get to, say, around 4550 or so, as a throwover in this pattern in order for the pattern to remain valid. But what we see right here is a high probability that the market is reversing now and should break down below what we would define as key support at 4370. And once we pierce that 4370 on a sustained basis, that will confirm this pattern and project a much lower directional move for the market, which should initially drop to around 4230 and then around 4,000 after that. So our insight today is basically, if we look at valuation, if we look at the leverage in the system and the signal that it's giving us on sentiment, if we look at the market's deteriorating breadth, and we look at the importance of this pattern, we have a final message. That all adds up to take profits now. So with that, I'd like to thank you for your time listening to this presentation. If you'd like to get in touch with me, you can send me an email at jhuge@jwhinvestment.com. You can follow me on Twitter at alpha_insights. You can always go to my website at jwhinvestment.com or find me on LinkedIn. I hope all of you have success trading today, and thanks very much for watching.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.